As of July 15, 2026, at the close of the regular trading session at 4 p.m. Eastern Time, the United States stock market is closed, and BigBear.ai Holdings, trading under the ticker symbol BBAI on the New York Stock Exchange, stands at an exact closing price of $3.14 per share, representing a flat 0% intraday movement from the prior session. While the casual observer sees a stagnant tech company stuck in a boring horizontal trading channel, the underlying order flow reveals a quiet, highly strategic accumulation by institutional desks that are hoovering up floating shares under the radar, setting up a structural tension that retail accounts are completely blind to. Most retail traders looking at popular investing sites assume that a $3 stock is just a speculative lottery ticket, but the reality is that the structural plumbing of the defense procurement sector is shifting in a way that gives companies with pre-existing security clearances an immense systemic advantage. The general belief surrounding BigBear.ai is that it is simply riding the coattails of larger mega-cap firms, living in the shadow of major market leaders where retail traders obsess over NVIDIA stock, Apple stock, or Tesla stock daily. The common narrative suggests that without the consumer-facing mass appeal of these retail giants, a small-scale data contractor cannot generate sustainable long-term value. However, this perspective completely misinterprets how institutional federal budgets are allocated. Unlike mass-market consumer tech, defense infrastructure contracts are sticky, deeply insulated from regular economic downturns, and incredibly difficult for new tech startups to win. When you look at how people manage their own capital through an individual brokerage account, whether they are using self-investing tools or looking for managed asset solutions, there's a tendency to focus only on big consumer names, but smart money frequently looks at the foundational plumbing, where massive government agencies distribute multi-year cash allocations. Looking closely at the recent market action, the daily trading volume for BigBear.ai has shown significant anomalies that demand closer inspection. Over the past few weeks, the stock has experienced compressed daily swings, bouncing tightly between $3.10 and $3.28, while the volume averages roughly 25 million shares a day. This low volatility compression combined with steady volume is a classic technical sign of institutional absorption. Big funds do not buy their positions all at once because doing so would spike the price. Instead, they slowly accumulate shares within a fixed window. If you look at your active charting tools on a comprehensive fidelity trading platform or an interactive brokers platform, you can see that the accumulation distribution line has been creeping steadily upward, even as the raw share price remains visually flat. This tells us that supply is being locked up by long-term players, leaving less free float available for short sellers to suppress. The broader macroeconomic environment is also playing a massive role in how small-cap defense data equities are being valued. High interest rates have historically pressured small firms that rely heavily on debt financing, but BigBear.ai has focused heavily on improving its capital structure to insulate itself from these pressures. For an individual investor executing trades via Robinhood stock trading or managing their long-term retirement planning through Fidelity IRAs, the impact of federal interest rate policy is always top of mind. For small enterprise software firms, high debt service costs can wipe out operating margins instantly. But because this company serves high-consequence environments where budgets are tied directly to national security priorities, their revenue streams possess a defensive utility that typical business-to-business software companies lack. This specific buffer is exactly why institutional asset allocators are beginning to view the defensive tech niche as a non-correlated asset class capable of withstanding broader market corrections. If we look back at the historical performance and the recent earnings reactions, the narrative becomes even more compelling. The company reported its fiscal Q1 2026 numbers, showing revenue coming in at $34.44 million, which actually beat Wall Street estimates by over 2%, alongside a narrow operating loss that shows clear signs of stabilizing operational costs. When those numbers hit the tape, the stock did not immediately skyrocket, which disappointed short-term options traders using the Robinhood stock app or SoFi active investing accounts. But seasoned market participants recognized that the stabilization of the gross cost of revenue, which sat at $22.71 million, proves that management is successfully integrating past acquisitions and reining in legacy expenses. The initial market reaction was muted because general retail sentiment was looking for an explosive, unrealistic growth spike, but the institutional reality is a business model that is methodically transforming from a manual services provider into a higher-margin software infrastructure company. Let us look at the structural reality of the corporate identity and what this business actually does at its core. Founded originally in 1988 and headquartered in Virginia, the company operates primarily as a provider of advanced decision intelligence solutions designed for national security, logistics supply chains, and digital identity management. They specialize in handling imperfect, highly fragmented data in environments where operational speed and security are mandatory. Their core products include data ingestion tools, predictive machine learning models, and visual optimization platforms that allow the Department of Defense, the United States Army, and various homeland security agencies to make mission-critical choices instantly. For instance, their sole source prime production contract for the Army's Global Force Information System is worth over $165 million over 5 years. This is not experimental software. This is deeply embedded operational infrastructure that cannot be easily replaced by a competitor. Comment below how many shares of BigBear.ai you currently hold in your portfolio, and let me know your average cost basis. Gathering this community perspective helps all of us see where the retail support lines are clustered relative to institutional blocks. When you analyze this business model against the wider software sector, you begin to see why standard financial metrics don't always tell the full story. A typical software-as-a-service firm is valued strictly on recurring subscriptions and user acquisition costs. However, a hybrid defense contractor operates on a backlog system, where contracted revenue is realized slowly over multiple years as milestones are completed. This makes the cash flow profile look lumpy on a quarter-to-quarter basis, which often scares off casual retail investors browsing standard investing sites or relying on simple automated summaries from a SoFi robo-advisor. But for sophisticated institutions executing orders via interactive broker stock trading, that lumpy short-term profile represents a mispricing opportunity. They understand that a multi-million-dollar government contract backlog represents highly secure, guaranteed future cash flows that are virtually immune to consumer spending drops that hit retail-driven businesses. Understanding the business requires looking at their recent strategic expansions, particularly their growing footprint in commercial and civil infrastructure. Beyond their massive footprint in national security, they have successfully deployed their biometric verification systems at major transportation hubs, including a major installation at Denver International Airport. This shows that their technical capabilities are highly transferable to commercial logistics, global trade, and supply chain tracking, where massive shipping organizations need real-time asset optimization. When a logistics company utilizes their discrete event simulations to predict route delays or optimize warehouse inventory, they are saving millions in operating efficiencies. This commercial runway gives the company a dual-engine growth framework, allowing them to balance the steady, secure baseline of government funding with the higher margin upside of corporate enterprise software. For individual investors structuring their personal holdings, selecting the right execution environment is critical when handling volatile small-cap assets. Whether you're holding equities inside a comprehensive Fidelity brokerage account, testing out automated logic through Schwab Intelligent Portfolios, or utilizing the simplicity of SoFi Invest, managing entry pricing requires patience. Using tools like the Fidelity mobile app or checking detailed interactive brokers' fee structures can help you scale into a position using limit orders rather than market orders, ensuring you don't get caught up in brief intraday momentum spikes. Because small-cap tech equities can exhibit sudden, violent swings based on single contract announcements, having a disciplined accumulation strategy is far more effective than trying to chase a sudden breakout after the news has already gone public. Looking forward, the tension between what the market expects and what the reality presents will likely be decided by a few key catalysts. The primary catalyst to watch over the coming quarters is the accelerating adoption of their secure generative AI frameworks within the defense establishment.